Liabilities. Again, I go to battle with the traditional definition of a liability. Most accounting professionals will tell you that a liability is an obligation to pay an amount you owe to creditors, be it an individual or an organization. My definition begs to differ. A liability is something that takes money out of your pocket. You can see the dilemma. Most would list their Mercedes as an asset or something of value. However, I would list the Mercedes as a liability because every month it takes money out of your pocket. But it's paid for, you argue. The car loan may be paid for, but what about gasoline, tune-ups and repairs, and insurance? The biggest fight Robert Kiyosaki, author of best-selling book The Rich Dad Poor Dad, get is when he tell people your home, your personal residence, is not an asset. He received a lot of flack for that, especially when times were booming and people were taking out loans against their home, sometimes 2 or 3 times. It wasn't until the real estate market crashed back in 2008 and people found out that they owed more on their house than it was worth before they started to understand their home was not an asset. If you haven't suffered through this experience personally, then please take my word for it, you don't ever want to be in this position. The bond between the financial statement and balance sheet. After you have completed your personal financial statement, you should start to see a correlation between the two components. Robert's rich dad felt that the connection between the two was the key to understanding how wealth is created. How can you understand one without the other? How can you tell what an asset or liability really is without the income column or the expense column? He asked. If you want to gain a deeper understanding of how the financial statement and balance sheet affect each other, you can discover more about it here. Why understanding the personal financial statement is important. The problem with people calling their liabilities assets is that they believe they are financially better off than they really are. When the economy turned, many people were forced to face reality, realizing what they have and how long they actually can survive financially. This is why the concept of net worth means very little in the real world. When accountants calculate your net worth, they list everything but the kitchen sink. In most cases, to have the dollar amount your accountant attaches to your net worth, you would have to sell just about everything you own, at whatever the market will bear at the time. This does not mean you shouldn't buy a house or a BMW or a new Cartier watch. It just means that when you're managing your money, you shouldn't fool yourself into thinking that your liabilities, items that take money out of your pocket, are assets. Once you understand the difference between assets and liabilities, and how to classify them on your personal financial statement, it becomes very easy to see where you actually are financially and how to build your own roadmap to financial freedom.